mode.
Yeah, hello, everybody. My name is Yuri Fedorkov, and welcome to the third uh, in the series of seminars that we're providing for clients. Today's seminar will be about the psychology of Forex trading, and I'll be trying to explain to you and try and my opinions and also what I see as important psychological factors in the market today. So, in order to begin with, I'll just give you a bit of background about myself. My name is George Fedorkov. I work in Alpari for approximately 4 years, and my specialty is to work with markets and to keep up to date with everything that's happening in foreign exchange, and to provide a service for clients um, in terms of what's happening, in terms of what we think are important points, etc., etc. So to begin the seminar, I would just like to point your attention to, I'll be going through the slides, as you can see in the middle of the screen here. So we're talking about the psychology of trading. Now, most people will not actually take psychology into account. Most people will kind of jump into a trading plan, jump into trading a particular currency pair, without necessarily thinking about the background behind the movement of that currency pair. So in terms of psychology is what do I mean by psychology? Psychology is essentially what traders believe to be driving the minds of other people. So sometimes psychology is the only thing that's driving the market, i.e. if there's no macroeconomic data, if there's no company releases, etc., sometimes traders will simply go on what they believe to be the mindset at the time in the market. So if we just take a couple of observations about the market, like in my personal experience, when I speak to clients, when I look at how people trade, I can more or less come up with a few observations that accurately describe what's happening. So the first thing is most people actually don't care about making money. Most people care about being right. And the way I know that is because most people, or a lot of clients that I speak to, get stuck in massively losing trades. So if you look at their trading history, they'll have sometimes even more than 50% winners, but the losing trades will be so huge that they'll completely decimate that person's account. So to me, that says sometimes that people get stuck into losing trades, and essentially they hope for them to turn around. Now, when you're hoping for a trade to turn around, that essentially is an egoistical view. Instead of having an objective view and getting out of the market and actually saying, look, this isn't a bad trade, I should get out, people actually stay in the market and try to hope the trade to reverse. Now, that is the wrong way to go about it. So sometimes you just have to be very analytical and leave all the emotion out of it. And so I concentrate on the profit rather than the being right. Let's say so your trading record only has winners, because a lot of people are tempted to do that. Literally, they start off trading, things start going well, and then they just hate to see that one losing trade on their account, which kind of makes them focus on the wrong thing, i.e. having a full list of winning trades. Now, other things is hopes and fears. So against it, essentially emotion. Emotions can make you see things that are simply not there. So for example, sometimes you'll see a market begin to rally and people jump on the back of that rally, and then they realize that that's actually too late. And they've just bought the high, for example, rather than waiting and selling the high, for example. So again, the hopes and fears are incredibly popular in the market. A lot of people just simply trade because it's on gut instinct, because they're scared of a certain thing, because they hope for a certain thing, rather than always sticking to a particular plan or a particular system that generates trading signals for you. And the last point on this one is essentially is that the markets around you are they are what they are. They behave irrespective of what you believe or what you do. So the notion that markets are somehow against you is, again, was very popular amongst beginner novice traders, and so that's why they often get stuck in trades that suffer large losses. So essentially markets can stay irrational longer than you can stay solvent. And what that means is, so sometimes even if you are right, so for example, you see that the particular currency pair should be bought or it should be sold, and you potentially are right, but if you're stuck in a trade and the market isn't doing what it's supposed to do, it can continue to do that for much longer than your account size can handle, basically. And that's to do with leverage and to do with the fact that a lot of market inefficiencies can stay in the market for extended period of time. So as we saw in 2008 and 2009, sometimes certain currency pairs will trade according to other factors, i.e. non-fundamental factors that kind of take the market away from where it should be priced. Now, and that can lead to people, again, getting stuck in trades and not getting out, even though they're suffering a large loss. So you can see these 3 points here, just underline, just to give you a quick overview of that, just how trading is from a mental perspective, how important that is. So excluding everything to do with the news, technicals, trading plans, putting all that aside, just how mentally people see the market and how they look at themselves whilst they're trading is extremely important. So in terms of psychology, once again, why is it important? Well, because if you think about it, every single market participant, whether it's trading Forex, whether it's trading commodities, wherever it may be, other people are essentially every market is comprised of just a cross-section of people or a certain amount of people trading. So their actions will be decided upon their views, and your action will be decided upon your views. So if you try and take that one step further, you will maybe try and think about what are other people thinking, and thus how they will potentially act in response to a particular event or in a particular factor in the market. And so experienced traders, traders that have been trading for several years and they've come to terms with this concept, they will often make trades simply on the back of what they believe less experienced traders are doing. So, for example, let's say there is a particular economic figure coming out at 130 or something like that. So the more experienced traders sometimes will see the number come out at 130, and instead of reacting to it immediately, like what less experienced traders like to do, they will wait to see what the number is, see what the reaction is, and then respond to the kind of the initial move, rather than looking to get onto that initial move. So that's just a brief, and that's probably the easiest and most brief example I can give of how experienced traders, without thinking anything about macroeconomics, without thinking anything about technicals, will simply go where they think the other people shouldn't be going. Essentially, so they'll take positions against those people that they believe are wrong, essentially, and are trading too soon or trading the wrong way. And one other important thing to consider when it comes to psychology and thinking about what other people will do is the understanding that market participants are varied. So, for example, myself and yourselves, we would probably be classified as retail traders. So traders with, let's say, a fairly small trading account. It's in your name, and you have a trading platform, and you go ahead and trade whichever currency pair you like. Now, but that's not the entirety of the market. The entire market is actually way bigger than that, and includes entities such as banks, hedge funds, institutional traders who have huge resources as opposed to retail traders. And so their actions and most importantly their incentives are different. So their goals are different. What they're trying to achieve from the various trades that they're putting on. So, for example, if we take the banks, hedge funds, institutional traders, and retail traders, their goals can be varied. So, for example, their goals can be speculative. It could be simply to fill client orders. So, for example, a bank may simply be filling client orders on a particular trade rather than speculating. foreign exchange is mainly a speculative market, so most FX trading is speculative, but a lot of banks, a lot of hedge funds will simply complete client orders, or will simply be hedging other orders that they've already done. So just thinking about the market motive is very important when it comes to psychology. So in practice, what does that mean on a daily basis is that sometimes markets will go in a particular direction for various reasons. So instead of actually speculative motive, sometimes markets will rise and fall on the back of a large bank prop trading, a large bank hedging, maybe a large M&A deal if you're trading equities, etc. So you can see it's not just about speculative FX trading on a retail level. The market is way huger than that, and that's what it's important to understand. So when you see big news come out on various TV channels, on various research platforms, on various comments, etc., always remember that there are various market participants looking at this news, and they will have different motives. And by understanding that as a cohesive kind of factor, so if you if you look at the markets as a holistic system where all markets are intercorrelated and all market participants are intercorrelated, it will give you a better understanding of which direction the market will go, and also with what volume it will go in that direction. So if we actually look at, go a step further again, and if you look at the psychology behind various figures and various macroeconomic data that is released on a regular basis, we can see that although there is various macroeconomic data, we have hundreds and hundreds of different factors of indicators, things like GDP, inflation, house prices, producer price index, consumer price. I mean, there's almost an incountable amount of statistics that are released monthly, weekly, and annually that help market participants and traders and people of all various agents of the economy to understand what's happening with various economies around the world. So, and thus currency pairs and equities will react to a particular number, etc. So let's say a GDP number comes out higher than expected. That generally means that the country is doing well. So it tends to mean that the currency will tend to appreciate. Interest rates are likely to rise potentially. So I mean, you get these various kind of assumptions that start happening as soon as a number is released. But the only reason that number actually matters in any way is because it affects one of three things. It affects either sentiment, confidence, or expectations about the future. Those three things are probably the most key, and you'll hear these three things probably most, especially on financial media and financial publications, is that these three things essentially drive markets: sentiment, confidence, and expectations. So when expectations change, markets move. When confidence changes, markets move. And when sentiment changes, markets move. So for example, even if a GDP figure is released, it by itself doesn't actually mean anything. It only means something if it changes expectations or confidence or sentiment about the future. And the same thing goes for, let's say, an equity. So if a company may release an annual report, for example, about its performance, the only reason that report matters to an investor or to the share price is because the expectations of future earnings or the sentiment about the company or the confidence in the company has changed. And that is very important to understand, because if you understand that, then you will be able to see that it's not actually macroeconomic data that moves markets. It's actually people's perception of the market that moves markets. So sometimes GDP doesn't have to fall for people to think that GDP is falling, and thus sentiment has changed, confidence has changed, expectations change. So to summarize this, is markets can move wildly and rapidly without any data whatsoever. They can move pretty much any reason at all, and if the underlying factor, the common denominator here, is people's minds and people's perceptions of the markets. So in terms of news, this is a very key component of psychology, because most traders, yourselves, I'm assuming, most of you will be probably intraday traders, maybe intra-week traders, looking probably for looking at macroeconomic data on a daily basis, on a intra-week basis, and again probably looking for trades that last no more than a few days. Now, if that's incorrect, I do apologize, but that's generally what most of the market participants do. They generally trade on a fairly short-term basis, and so if you are trading on a fairly short-term basis, then things like news releases will be extremely important, even if you aren't planning to trade those particular news releases. And that's simply because everyone understands that markets move because of macroeconomic data, and they move sometimes very rapidly and very unexpectedly. So if you actually look on that point on itself, what is it? Well, let's explore that further. So what happens is every day there are a particular amount, certain figures that are released. Just to give you a little example, this is a fairly a very popular website that is used by many retail traders in order to get the latest news releases. And as you can see, there are. This is just for example for today, so November the 15th. As you can see here, so that's the figures for today. And you can see throughout the day, this is UK time. So as you can see throughout the day, there will be news released consistently throughout the day, and that is going to lead to markets moving and again expectations changing, sentiment changing, and obviously various currency pairs are affected depending upon which figure is released. So what does this mean for a trader? So a lot of people tend to look at these figures and tend to try and take advantage of them because obviously the market moves quite rapidly, and that's why a lot of people are tempted to trade them. So what tends to happen is that expectations are formed. So banks and various other large organizations, they have analysts analyzing a lot of this data beforehand, and they come up with expectations, and kind of like an average is formed. So they ask around 100 or 200 analysts what they believe to be the estimate for that month or for that week for that particular bit of data. So for example, let's take the data coming up this afternoon. So for example, let's take core retail sales in the US. That's predicted to be at 0.2%, and the previous was 0.6%. So a lot of US dollar traders and a lot of Euro US dollar traders will be looking at this number because they believe that retail sales represent a picture of the consumer in the US, and the consumer market in the US is fairly large, tends to affect US growth and US GDP. And that's why it's likely to have an effect on the US dollar if that number is significant, i.e., if the actual number is significantly higher or lower than this 0.2 figure. So as this number is released at 1:30, a lot of people will look at the actual number and try to see how that compares with the average that's been taken of the expectations, as I mentioned. So if it's significantly out of line, there's going to be a move, and people will try to react. Now, the key point here is that there will be a herd situation, i.e., people tend to react kind of in similar fashion all at the same time, and so you have a concept called like mass behavior or herd behavior occurring. And what that tends to happen in financial markets is that if everyone tries to go for the same price or everyone is going in the same direction, you get an extreme move in that direction because everyone is going essentially for the exit at the same time or is going for the same price all at the same time. And this can lead to things like slippage. It can lead to things like missed prices. It can lead to gaps in markets, etc. Where prices essentially change from one price to the next, and there's a huge gap in the middle, i.e., where there was no trading happened. Now, this happens because of everyone going for the same, attempting to do the same thing all at the same time. And then if you think deeper into that, well, that's because everyone is acting in their own interest. Everyone wants that initial price. Everyone wants, for example, let's imagine that the retail sales figure this afternoon is, let's say, very positive for the dollar, and euro dollar subsequently falls. So everyone will be trying to sell euro dollar immediately on the back of that, and be trying to get the best price, i.e., the highest price to sell at. So, I beg your pardon. So, what that will lead to, or very likely will lead to, is that the euro dollar currency pair will fall very rapidly, and a lot of people won't be able to not everyone will be able to get that initial sell price, because always remember that for every seller there must be a buyer. So if everyone's trying to sell, then no one is buying, then the price has to readjust down to a level where there is enough buyers to meet the selling supply. So, and this is why you have kind of extreme moves. If you actually look at a particular number, to give you a quick example, if you just take an example here, if we take the euro dollar chart, for example, let me just have a look. 1 second. So I'll just get a chat sorted out while I continue. So and what happens then is when a significant amount of people act simultaneously, the price effect is exacerbated. So you tend to get really, really strong moves in one direction. Now, one other thing very important with news is that a lot of the time news will be released and people will try to react to that number, but then they'll say, for example, so let's say a number is positive, let's say for the US dollar, yet the US dollar falls, or let's say the number is positive for sterling, but sterling falls, and a lot of people say, well, that is counterintuitive. This shouldn't be happening. Why is the market falling when it should be rising if it's a positive number, for example? Well, that is because, again, all to do with expectations. So sometimes a positive number is not as positive as expected. So it's actually in real terms, it's actually a negative number, and vice versa. Now that's a very key concept to understand. It's all to do with expectations, and this goes back to the original point I made at the beginning of the presentation, in that it's not actually the GDP number or any particular number that matters per se. It's the expectations around that number that matters. Now, in terms of macroeconomic data, as many of you will know, I mean, the various data that's released on a daily basis affects most markets all at the same time and all around the same time, because they're all released around the same time during the day. So, for example, UK data is released around 9:30, 10:30 in the morning. US data around 1:30, just before the US Open at 2:30. And you have and in the Asian session, you have data released out of Japan around midnight, 1 in the morning, 2 in the morning, etc. So, I mean, a lot of these events tend to lead to large moves in the markets. Now, again, always remember the majority of trades that happen in the Forex market and in futures markets as well, and to a large extent in equities markets, is speculative. So whether it's because of comments or macroeconomic data or company data or auction data, I mean, this one here is a big one. Recently, because of what's happening in Greece and what's happening in the US. So essentially bond markets are very, very topical right now, and yields are extremely topical as well. So auction data, so how bond auctions how bond auctions are held, and how successful they are is an extremely good or an extremely sensitive market factor now. And this has changed. So, for example, prior to 2008, 2009, bond auctions were fairly boring events. No one ever really paid attention to them. You know, they were fairly not very big events, because there was not really a big debt issue. There wasn't really a sovereign debt problem. No one really was paying attention to that. I mean, everything was considered to be okay. Now that a lot of the fiscal problems have come out in the US and Europe and Japan and generally across the world because of the financial crisis that we've seen a couple of years ago. So bond auction data, especially German bond auctions, Greek bond auctions, so European bond auctions, and the US ones. So essentially bond auctions from countries where debt is becoming a huge problem, they're becoming huge issues now. And following on from that, so the yields spreads between various bond auctions are also looked at, and also things like bid to cover ratios are looked at. So I mean, these kind of terms and these kind of statistics are very important, again, for both for traders on a daily basis and also for the psychology of trading. So, for example, so when a person may be trading a particular macroeconomic number or a particular or trading on a particular day, if there is a bond auction on that day and you don't know about it, then that's not good. You will be essentially behind the rest of the market and unlikely to have you will be less informed. Let's say, I'm not saying you'll maybe be less profitable, but the more informed you are, generally, on average, means you will make better, more informed trading decisions, and generally they will be more profitable. Now, and what does that mean? Well, that means that it's very important to be informed. So, knowing when bond auctions are happening, that's probably one of the key things. Find out when they're happening and find out what is expected, and be ready to react to that. So things like bond auctions are not really they're not really published on things like Forex Factory or some of the mainstream retail sites. So you're gonna have to go a little bit deeper and actually go to various government websites. For example, the Treasury website in UK, or some other more technical websites which give you a slightly better idea of what's happening, not just the run-of-the-mill macroeconomic data a lot of websites have. And other factors, of course, that can have effects are things like politics and political changes, etc., and geopolitical, so things like wars, etc., and natural disasters, etc. Now, a big one a big one that kind of affects most markets on a almost daily basis is rumors, and rumors generally they generally affect markets when there is uncertainty. So whenever you see markets uncertain and things not really, uh, um, let's say, not really, like for example, what's happening in Europe now, where there's not really a lot of certainty, there's not really a final plan, not really a final solution to anything. So what you'll tend to find is any rumor that does the rounds in terms of European bonds or Greece or various or a particular default may be occurring soon, etc. So rumors of any of that nature will get traction quite quickly, and will move foreign exchange pairs and equity markets, etc. And whereas, for example, if things are quite certain and and markets are quite stable and generally upbeat, then rumors are not as common. So, for example, in 2008, 2009, rumors were probably the only thing responsible for some of the short selling that we saw in UK equities. So it was nothing else. It wasn't really any macroeconomic data. It wasn't really any comments. Wasn't any particular political events or any macroeconomic events. It was simply rumors of banking instability, banks not being able to fund themselves, etc., etc. And last but not least is M&A. Well, mergers and acquisitions can have an effect even on currency pairs. I mean, this is a fairly small issue, and generally M&A deals are not really don't really have effect on FX. But generally, for the psychology of people, is that M&A, whenever you see M&A deals go up or whenever you see big M&A deals go through, it tends to mean that the macroeconomic environment is generally positive. And again, that's kind of like a very broad indicator of risk, I would say. So if M&A deals are rising, I would say that's risk friendly, and investors are willing to take risks, and generally things are looking good from a risk perspective. Because if you notice, a lot of financial publications, they'll all very often talk about risk on, risk off. So, for example, if something, you may read an article, something that says, "Oh, today was a risk on day" or a risk off day. What that means is essentially that a risk on day generally means investors and speculators are happy to take risks on things like commodity currencies, equities, oil, equity futures, indices, these kind of, but generally markets which have higher yields and higher risk, and which are generally kind of more volatile, so commodities, etc. Risk off generally means where investors are not really happy about what's going on, and they generally want to take risk off the table, and they generally want to go into gold, the yen, the dollar, the Swiss franc, government bonds, let's say US government bonds, German government bonds, etc. So generally products with a low yield but with a low risk profile. And again, so by looking at things like the amount of M&A deals that are happening, by looking at various other indicators, like you have things like the VIX, which more measure volatility. So but there are various different indicators will give you some kind of inkling as to what risk is, what the risk sentiment is, let's say, in the market. And risk sentiment is, as we mentioned before, sentiment is a very key point. So regardless of macroeconomic data or any technicals, the risk profile of a market, so how investors generally are, whether are they generally risk on or risk off in a particular market, is sometimes the only thing that is moving that market, and that's very important to understand. Now, to give you a really like basic example is in terms of being informed and the importance of having the right information at your fingertips is like for just a little did you know is that, well, for example, if you're trading the US dollar, the US dollar is actually heavily influenced by dairy auctions, so dairy products, like cheese, milk, etc. Now, it sounds quite far-fetched, but that is actually one of the biggest influences on the New Zealand dollar. Why? Well, because New Zealand exports a lot of dairy products. It's one of its major export markets. So if dairy prices are falling, and if generally the dairy market in New Zealand is not doing so well, then that is likely to mean that New Zealand dollar is not going to be in as much demand as in the future as it would be otherwise. So for example, looking at what I believe they happen twice a month. So these dairy auctions happen twice a month. So if you are trading New Zealand dollar, it is worth paying attention to what these auctions are. How successful they are, what they were previously, how that compares, see if there's any comments that are coming out from officials surrounding those auctions, etc. So, I mean, so for someone who's not aware of this point, for example, they would be trading New Zealand dollar without knowing this. And so, for example, a dairy auction may come out, and New Zealand dollar will adjust to that macroeconomic event, and yet that particular trader may not be even aware that auction's happened, let alone know the reason behind why the price has just changed so rapidly. So as you can see, the factors that drive a particular market are very important, and sometimes it's worth doing the research prior to picking a currency pair, or prior to picking an equity or a commodity. So before trading that commodity, whatever product you choose, it's worth finding out what exactly is the drivers behind it. So what exactly will affect this market and when? Because that will allow you to, again, become better informed and be more ready for various events surrounding that product. So in terms of kind of actual trading on on an intraday basis, what tends to happen to novice traders, and how can you avoid some of these problems? Well, novice traders, what they tend to do is, instead of kind of doing what they would do in kind of logically, instead of applying logic to their trading decisions, they tend to apply emotion to trading decisions. So what you tend to find is novice traders will see a market rally quite quickly, and instead of actually seeing that small rally for what it really is, they'll simply try and buy it because the market's rallying. So what novice traders tend to do is they tend to see buyers. So what looks like a buy, they'll actually sell, and what looks like a sell, they'll actually buy, simply because their emotions or their instinct is telling them that, rather than actually seeing that rally for what it really is, or that seller for what it really is. So the reason that tends to happen is because, well, partly because of the lack of experience, but also because generally it is quite tempting sometimes to see the market rally quite quickly, and to think, or to perceive that there is some kind of news out in the market that there is that's made that currency pair, let's say, go up or down, and thus it's simply a knee-jerk reaction. So and making knee-jerk reactions generally is not a good idea, because again, it's generally a better idea to stick to your trading plan and actually look for exactly what you're looking for, rather than to take opportunistic trades. So, I mean, what usually happens is when people see a trend going up, let's say, and then they tend and buy it, that tend to means that, I mean, a lot of the upside price action has already been priced in, i.e., it's now become a seller's market, and yet the trader is still buying it. So as the clever money is actually looking to sell this market now, a lot of traders will tend to will still be looking to buy, and that's why they all get stuck in literally long the high and short the low, and that is not a good thing to do for obvious reasons. So that's why it's very, very important to kind of try and almost identify what the market is thinking, and try and get ahead of the market, rather than trying to catch up to the market, or go with the market. Now, one extremely important point in terms of the psychology behind trading, and this is I'm going to talk about in terms of things like execution, and things like actual the actual logistics of trading. So whether you're a small trader or a large trader, or the bank, or whatever else, you will have to make a choice whether you're going to trade OTC products or exchange traded products. And there is a slight difference between the two, or actually a lot of differences between the two. So exchange traded products are generally those products traded on exchanges, so exchanges like CME, Euronext, Eurex, etc. And they'll generally be standardized contracts or standardized products which are traded through a central intermediary. So essentially an organization that will sell orders and buy orders from buyers and sellers, and distribute the buys and sells amongst them in a very fair way, or as fair as possible as can be, basically. And there's various ways that they'll do that through pricing, matching, etc., etc. There's also transaction enforcement. So again, every transaction is fixed, and so buyers and sellers are deposit margin with the exchange, and they are required to go through with the actual decision that they make. There's no trades aren't reversed, for example. Now, OTC markets, over-the-counter markets, are quite the opposite to that. There isn't a central exchange, so you can actually deal with many mediators at one point. So, for example, if you're trading one currency pair, there is no one price for that currency pair at any one time. Every broker is offering you a different price at any one moment. Whereas with, let's say, exchange traded product, there'll only be one official price that you can actually check on with the exchange. So obviously that creates, some of these things create disadvantages and advantages, obviously. So if you actually look at the slide in front of you, I've just summarized them in a few bullet points. So FX markets are OTC, so they're over the counter, and this can provide opportunities in its own right. So the fact that you can price discriminate in arbitrage means that you can actually discriminate between the prices of various brokers, which is a lot of what traders try to do. You also find that OTC markets are quite low cost and are very accessible. That's why kind of retail traders can trade them, whereas exchange traded products, things like futures contracts, etc., usually have a high entry price. So generally the margin is very high. And so the minimum trade is generally quite high. So as a result, generally retail traders prefer to trade OTC markets like FX. Now, one very important thing when talking about psychology of trading, so trying to identify what other people are thinking when you're doing Euro trading, is causality. So a lot of people kind of take a very simplistic approach. So they kind of see a figure come out, or a macroeconomic number, or a comment, or let's say I don't know, a bit of company data. So generally, one of the things that we mentioned was a factor in driving currencies, and they'll tend to kind of assign a lot of importance to factors that don't have a lot of importance. So, for example, let's say there is a fairly strong bit of data that comes out in a particular country. Let's say it's the an inflation figure, for example, in the UK. Now, if that number is out of line, yes, will tend to mean that that's unexpected and expectations are changing, and so there should be an adjustment in price. But what that doesn't really tell you is that is causality. So causality is in terms of what actually affects currency pairs. So yes, we know that sentiment affects currency pairs and various macroeconomic data and confidence, etc., etc. Yes, but there are certain factors which affect currency pairs more than others. So from statistical research and from correlations, we can actually identify what affects which factor affects which other factor and to what extent. And what we found is that in actual fact, most currency pairs are actually most sensitive to interest rates by quite some margin. So, for example, if you were to see a factor that affects interest rates, so whether it's a comment or a figure or some kind of or a rumor, if it's talking about interest rates, that is more likely to affect the currency pair than if it's talking about, let's say, GDP or let's say another macroeconomic number. So interest rates are pretty much the most important factor when it comes to currency pairs, and that is why traders will attach more importance and will focus more on events that affect interest rates. So it's kind of logical that they'll do that. And so that's why interest rate differentials. So the next step from that is interest rate differentials. So the difference between interest rate in one country versus another, and how that differential is changing. That will also be important. And you also have to remember that currency pairs are always done in pairs. So, for example, euro against the dollar, euro against sterling, etc., etc. So it makes sense that interest rate and their differentials between two countries are going to be the most important factor when it comes to the two currencies against each other, so in a currency pair. So, for example, one of the probably the most biggest factor for affecting the euro sterling rate is the interest rate differential between Europe and the UK, and also the expectations of future interest rates in Europe and the UK, and how those two factors change will influence euro sterling rate on an intraday basis. So, for example, if we have a figure out in the UK, let's have a look quickly at the figures that we have out today in the UK. So, for example, this morning's figures, as you can see here, that we had a CPI figure that was slightly less than expected at 5%, and we had an RPI number that's slightly less expected at 5.4%. Now, if we just take a quick look at what happened to the chart at that time. Just bear with me. So this is a sterling dollar chart for today. Now, as you can see, the CPI number was released at 9:30 UK time, and there was also other figures at 9:30 in UK. So if we look at the chart, here, and we look at 9:30. So roughly here, you can see that. Let's put it just a 1 minute time frame. So if we look at 9:30 around here, you can see that the initial reaction. So the number was released at 9:30, and that looked to have a positive reaction. So we had a some buy action here, and not but generally it wasn't really a reaction. If you can see those two candles, these two green candles are quite small. So let me just annotate here quickly. So as you can see, these two candles here are quite small. But what's more interesting for me is rather than what's happened after the number. So what's not what's happened here after 9:30, but what's happened before 9:30 here. This huge selling before 9:30, and why? So if we actually look at the chart here, so after the number was released, we actually saw very, very little movement. If anything, the number was as expected, but before the number there was a lot of selling. So what this generally represents to me is we had speculators prior to the figure. We had speculators selling sterling against the US dollar on the expectation that numbers would be quite negative, i.e., we would see quite a kind of inflation kind of go out of control. A lot of people were thinking that inflation would be revised even higher. And although inflation generally means higher interest rates and a stronger sterling, well, at some point you kind of have a situation where people see inflation as starting to become a negative factor, and so they will generally sort of lose confidence in a currency if inflation begins to rise to kind of beyond for a considerable amount of time and beyond kind of expectations. And so for me, so today, prior to the number, this is a good example of how traders, market participants will often trade prior to a number, even more so than after a number. And that's because the number didn't really mean anything. The number was more or less expected. It was very small difference between expectation and actual today. So in the end, it was actually today's CPI number was all about what happened before it, and essentially people looking to speculatively sell into that figure, and essentially that's what's happened. So just to give you an example, so whereas a lot of traders would probably have been looking to today at that number at 9:30 and literally only acting after 9:30 and not actually taking advantage of the opportunities that were there before. So for future numbers that are coming out, it'd also be, for example, so this afternoon for US retail sales and for PPI, for example, or even let's say for tomorrow, if we have to look at tomorrow's figures. So for Wednesday, so tomorrow we have a huge lineup of numbers with there's a UK inflation report tomorrow and a very important inflation number in Europe, as well as Japanese interest rate decision overnight. So again, this is going to be these figures are quite important given current economic conditions. Everyone's looking at what's happening in Europe to see how that's performing, to see how that's going to affect the EFSF and the bailout, etc. And vice versa. For example, this figure here, the tick long-term purchases in the US, that's going to be huge. Because this is an indicator of how of the demand of U.S. debt of long-term investment in the U.S. So by foreign entities. So again, all these indicators give market participants some kind of confidence level or some kind of level of expectation as to the future of each of these countries. So looking at these numbers, i.e., what they were previously. So for example, looking how this number has evolved over the past few years or few months or few weeks is actually very important, rather than just reacting to the particular nominal number that's coming out today. For example, for this particular number tomorrow, but if you see what I mean, it's very important to actually understand the background behind each of these macroeconomic numbers, and thus very important to understand what people are thinking behind these numbers, not just the number itself. Because number itself can be, for example, this number here. If we take, let's say this core CPI number in US, this number tomorrow can be above expectation, so i.e. dollar positive, and yet the dollar could fall still, and that's all to do with what the CPI number is, how high that number is, and what people expect as a result of that CPI number. So if inflation in the US is very extremely high and it's getting out of control, it's actually going to be dollar negative, and that's what most people are going to think. Most traders are going to believe. and that's why it would be a dollar sell. But on the other hand, if inflation is rising, but not so strongly, and it's likely just to lead to stronger interest rates, then that's likely to lead to a stronger dollar because of higher yields that are likely to be generated out of the dollar. Now, the situation of the dollar at the moment is that interest rates are held like at extreme lows until at least for another 2 years. So, if anything, high inflation here will be quite dollar negative because market participants already know that the Fed is will hold rates low, and there's very little chance that will change. If anything, there's going to be more easing in the US, i.e. more quantitative easing and more. So the dollar is going to be diluted further, if anything. Right? That's generally the expectations. Okay. Well, that more or less brings what I have to say to a conclusion. I mean, I did have quite a few more slides prepared, but I just really wanted to take care of the kind of the psychology part of it first, and just to show you a few of the things that I think matter. But I will send all of these slides to you if you wish. That's not a problem. I've just included, just to give you a quick glimpse, I've included a few statistics. So what's happening in terms of charts and various performances of various currency pairs. Just included a few charts for you. It's not really not really dealing with the psychology of trading necessarily, but more to do with various other factors, so actual statistical factors, what's happening with inflation, what's happening with FX pairs, how they're changing, and what's like currently the various trends that are occurring at the moment. But if you do have any questions, I will be more than happy to answer them for you. And I'll do that. I think I'm going to do that via text in the. So if you just put your questions through into the questions box on your screens, then I'll be answering them now. So we have a question here. So what is scalping? So scalping is is essentially a trading strategy whereby the trader is looking to take a few points at let's say, the best way is just to show you on our trading platform. So I'm just going to launch MetaTrader 4. This is the trading platform that we use as a company. So Alpari, this is what we offer our clients. So I'll just pull that up and I'll show you what is scalping. So for example, here we have when you can see on your screens here we have a euro-dollar chart, 5-minute chart. So for example, scalping would be is essentially a trading strategy whereby a trader wants to trade the currency pair and make a quick profit and get out quite quickly. I.e., scalping is generally very short term and generally for a very small profit. So as you can see here, the current price now of euro-dollar is 32 bids, 34 offered here. So for example, the trader would attempt to buy, for example, 34 here, or 35 as it is now, and try and sell 36 or 37 very soon afterwards in order to make a quick profit. I.e., you want the main goal of the primary goal of a scalper essentially is not to be in the market for very long and to take a quick profit as quickly as possible and to reduce his sort of exposure by not being in the market for too long. Essentially, it's scalping. We have another question. Do prices vary between different exchanges? Yes, they do, but that's depends. So, for example, some products are offered on several exchanges at once. So, for example, you can get gold offered on various exchanges. You can get various other products. So some currency futures are offered on different exchanges. Generally, the differences are not that huge. I mean, for example, if the products are comparable, if the actual contract or the underlying good is, if they are very similar, then you're not going to get a large discrepancy in prices. And the other thing you have to remember is a lot of traders, a lot of people, they discriminate, so they will arbitrage between the two. So generally, you don't have a lot of prices. You don't have a lot of price difference between exchanges unless the products are completely different and they're not comparable. So looking at the question. What charting platform was I using? I was using Pro Real Time. That's just Pro. If you go into Google, Pro Real Time, that's a very simple one. Just answer that quickly. Presentation slides, yeah, we'll send that out to everyone. Just if you just email us, if you email me directly, or if you have to email one of the email addresses, I think you should have a support email address. I think it's should have been given to you in an email or into with your confirmation email. You can just email that with a request for slides, and I'll email them to you. Yeah, and I'll send you the presentation slides in PowerPoint format or PDF or something like that. Don't worry about that. Just going through the questions, have a look, find a good one. I've got a good question here. So, can you use the current sterling yen outlook to explain interest rate differential? I.e., why is it not moving in the direction you would expect from the differential? Okay. Let's have a look at the sterling yen chart. Hold on. Okay, so we have a sterling yen chart here. That's on daily time frame. So weekly time frame. So let's just stay with the daily. So I mean, as you can see, sterling yen is in a kind of. I'll just have a quick look here. So for me, if I look at sterling yen on a daily chart here, although as you can see throughout 2011, it's on a general downward direction, generally downward trend on a broad downward trend. And for me, yes, the differential is so yen interest rates in Japan are very low and likely to stay like that for some considerable time, and that's more or less the same in the UK. So in terms of interest rate differential expectations, there's not really, both market participants generally expect both to stay fairly low for a considerable time. Although, and if anything, so sterling is actually even more, let's say, dovish than Japan in terms of, although its current rate is slightly higher, in terms of quantitative easing, there's expectations of more quantitative easing are strong in the UK. We're likely to see probably on top of the 75 billion announced recently, we can probably see even more. Generally, the big problem in the UK, though, for me, is not necessarily anything external, but internal. So, UK domestic demand is very stagnant. People are saving more, and generally spending is not so great. So, UK's problem is not necessarily from a foreign investment perspective or from foreign inflows or foreign exports. It's generally internal. And so the sterling yen chart, what it's reflecting for me is more importantly is yen demand rather than sterling weakness. The yen has been strengthening pretty much across everything this year. If I just bring you back to this chart here, as you can see, that's the yen performance in 2011, as of the January 1st, 2011. As you can see, the yen is higher on pretty much against pretty much everything. So it's the highest against CAD. It's again, if you notice here, the three currencies it's strongest against is the three commodity currencies. So the Canadian dollar, New Zealand dollar, Australian dollar, and against sterling as well. It's 2.1% higher against sterling this year. Now that just reflects safe haven demand, and it reflects uncertainty about Europe. It reflects the fact that people are generally unhappy about, or they're generally unhappy about fiat currency in general, and the debasement of the currencies of the developed world. They're generally unhappy about that, and so they're going for the currencies that they deem to be the safest, and generally they want to put their money where there's least exposure to bank risk and default risk, and that's generally Japan and Switzerland for the time being. That could easily change, and that could change quite quickly. But for the time being, this year, that's been generally the feeling that people have had. And you've seen yen demand and Swiss franc demand. As you can see, these two charts just to show you. The Swiss franc is the second strongest this year. The yen is the strongest, simply because of safe haven demand. Now, if you look going back to this chart here. Going back to the chart, so I would say the chart doesn't really reflect interest rate differentials. It reflects broader risk profile, and you can see, for example, this bounce. If you can see the bounce that starts here and goes up to there, that was essentially the when when things were looking quite positive, i.e., when people we're seeing there was supposedly a European solution. If we actually have a look at what date that exactly was, we see so beginning of October we saw a small bounce in sterling yen up until the end of October. So throughout October, sterling kind of bounced against the yen, but now it's rejoining the downtrend. I strongly believe that will continue because tomorrow's inflation report for me is not going to be great. It's going to be quite downbeat. Generally, Mervyn King is not very positive surprise merchant, but rather the opposite. And so, if anything, we're likely to see a more downside to confirm this trend line here, to meet this trend line down here at some point in next year. So that's personally my view on that one. Let's have a look at some more questions before we've only got a few more minutes. Let's see if I can answer some more questions for you. So yeah, don't worry about the slides. The slides they'll be. It's just if you just leave your email address, send us an email to what you should have an email in your inboxes or on your reminder email. So just send your request for that there, and we'll email you some slides. No problem. Just a quick question. We're looking at when looking at figures, i.e. head and shoulders, is it best to look at on charts of 5, 15, 30 minutes or other? For example, head and shoulders or any other chart pattern for that matter, it doesn't really matter what chart pattern you're looking for. Generally, the time frame for me is the stronger the time frame. So when you see the pattern on any time frame, the longer the time frame, the stronger that pattern will tend to be. So if you see the head and shoulders forming on a monthly time frame, that's going to be way stronger than a monthly head and shoulders on a 1 minute time frame. And obviously, and in between will be kind of a mixture of two. So my personal opinion is that more broadly is if you're going to trade on a 5 or 10 minute chart, if you're going to look at 5 or 10 minute charts, you should really be in trades for 5 or 10 minutes. If you're going to trade on a daily chart, then you should really be in trades for a couple of days or a few days or maybe a week. So generally, the time frame using for charting is very important because for example, if you're looking at a 5 minute chart, but holding the trade for let's say a month, then there's not really a lot of connection there. For me, it doesn't make any sense. And vice versa, if you're looking at a monthly chart and trading and you're getting in and out of trades every 5 minutes, then that also doesn't make any sense. So it has to be a balance. And so I would say that you try to look at all time frames. Try to stick to 1 or 2 products only. So try to really analyze and go into detail for a few products at a time, not let's say 10 or 20 at a time. And try and look amongst all time frames. Try and pick out opportunities in all time frames. Why not? And try it. If you find some success trading later time frames, then that's fantastic. If you have success on lower time frames, that's also great. But just test it and prod it. A bit of experimentation is going to be required, and that's why you have demo accounts. That's why you have trading histories, etc. So yeah, give it a go. I mean, I wouldn't say necessarily concentrate on any one time frame or any one particular indicator. Here's a good question. What is the biggest difference in psychology approach have you noticed between novice and pro traders? Well, I'll say the biggest one is discipline. So the better traders tend to be disciplined people with hardly any emotions in their actions. So generally, guys who are very numbers focused, who will go by their trading plan like their Bible essentially. Who generally won't get into trades on instinct. And another factor that the pro guys have over novice guys, that pro traders generally have very strong routines, i.e. what they do and how they do it is more or less the same every day. There is not really a difference, whether it's Monday, Tuesday, or Wednesday, whether it's January, February, or March, they will have the same routine with the same approach, with the same analysis, and that's what gives them that opportunity to find opportunities, and because opportunities essentially just pop up in front of them rather than them having to scour for them. That's for me, yeah. Well, anyway, guys, I think this more or less coming to the end of the presentation. Thank you for listening, and thank you for joining us for this third invitation. There'll be another one coming up this Thursday where I'll be covering latest market update, and by all means, send me questions. whenever you can. Thank you.